Good morning and happy Friday. My name is Namaan. I'm the Chief Operating Officer of Management Consulted. It's Friday, May 16th. We made it. You are almost to the end of your work week and to the start of a weekend. I'm here for another edition of Market Outsiders. I am kicking it solo today. My co-host Jenny Ray is unavailable, but I'm excited to be with you today to talk a little bit about the US housing market. And so, if you've listened to Market Outsiders for any amount of time at all, you know that the goal of this short daily podcast is just to give you a sense of what's happening in the markets, what's happening in the economy, and what it actually means beyond the headlines. When I read the headlines, I see a lot of misleading titles. I see a lot of insights that I don't necessarily agree with. I see, a lot of data that could be misconstrued. I see a lot of data that can be interpreted many, many different ways. And so when we work with our clients, when we work with large corporations around the world, one of the things that we're doing for them is we're bringing our industry perspective and our insight to bear to help them solve specific problems that they're facing at the leadership level. And so these are conversations that we're having internally all the time. These are conversations we're having with our clients all the time, helping them to navigate this economic landscape. And so we thought, let's bring these conversations to you as well and build and grow our business acumen together and learn from each other. And so today, what I want to do is I want to talk briefly about the US housing market. And so, what I'm going to do is I'm going to share my screen here. I'm going to show you just a little bit about what I put together. If I can get this to work, there we go. And so I was looking at the headlines this morning, and in a couple of different places, I found some stories and some data about how the US housing market is slow. And if you look at the headlines or if you just kind of read the news, you'll get that, but you won't get much else. All you'll know is, oh, okay, sales are down, right? And maybe the article will blame interest rates, and that'll be the end of it. And so it gives you like a real level one understanding of what's happening, but not necessarily the longer term implications. So that's what I wanted to try and unpack today and wanted to share with you why I'm watching the housing market, why I care about it, why I click on those articles when they pop up. The big picture is this: the US housing market is 16% of GDP. So we talked on an earlier episode about what GDP is. It's the value of all goods and services kind of created and consumed inside of an economy. And so 16% of the US economy, it's fair to say, is directly tied to the strength of the housing market. So this is a large part of the economy. And when the housing market isn't doing well, it's not a great sign for broader economic strength and health. So that's why I care about it. That's why I pay attention to it. So that's the big picture. Now, what's happening? It's true, the housing market is stuck. Demand is at near record lows, even as supply increases. So one of the things that I found interesting as I was doing some reading across different sources is that builders now have more completed but unsold homes sitting on lots than at any time since 2009. So think about what happened in 2008, 2009. We saw a crash in the housing market. There are, people going into foreclosure. There are a lot of kind of new builds sitting completed but unsold. We are now here in May 2025 at the highest level of completed but unsold homes since 2009. That's a pretty big deal. And so supply is increasing, but demand is remaining low. And so what's happening is that these builders are offering sweeteners and mortgage rate buy downs to keep housing stock affordable. So think about it from a builder's perspective. If you're developing a neighborhood, if you're building a neighborhood, what you don't want to do to make housing more affordable is drop the price. Because what that does now is it lowers the comparable price that every other house that you built in that neighborhood and maybe every other house you're building in that region is going to be tied to. And so that's going to hurt you longer term, even if and when the market comes back. So instead of dropping the price, what these builders are doing is they're leveraging their lending arms to reduce the interest rate that home buyers can borrow at, which means that their monthly payment is lower, even if they're not necessarily lowering the overall price that buyer is paying for the house. So they are pulling the interest rate lever and they're using their lending arms to do it to make their houses more affordable, to spur demand while ensuring that the sticker price of their houses doesn't drop. So the strategy makes sense to me. It's what I would be doing if I was kind of a mass market home builder. But the thing is, it's not necessarily working. So the sweeteners that they're offering, the mortgage rate buy downs that these companies are offering are equivalent to 8% of the purchase price of a house. That means that you're getting 8% of the value of the house back in some kind of incentive. It's almost like an 8% discount. This is 1% higher than what the discount was in January. This is the highest level that we've seen these sweeteners and mortgage rate buy downs been in almost 2 decades. So home builders are really trying to spur demand, and it's not really working because when you take these sweeteners and mortgage rate buy downs into consideration, the interest rate that these home buyers are paying, if they're going through the lending arms of these builders, is 5%. So the interest rates today in the market are around 7%. So what these home builders are saying is, look, we'll give you these buy downs, we'll give you these sweeteners, we'll bring your interest rate down to around 5%, which to most of us, if we were in the housing market, sounds great. It's like, look, in a 7% interest rate world, I will happily take 5%. And you would think that that would start to spur some kind of demand, but it's not happening. So even as supply increases, even as these builders work to bring the effective interest rate down that home buyers would be paying, we are seeing slowing purchase activity in the housing market. And so existing homeowners don't want to sell because they are locked in to incredibly low interest rates. Here in the US, we have 30-year fixed rate mortgages. I know the rest of the world isn't necessarily like that, but over half of homeowners in the US are locked in at mortgage rates that are under 4%. And so when you look at the market and you say, okay, the interest rates in the market are 7%. Even if I was going to go through a home builder that would offer me incentives, my interest rate would be 5%. Why would I sell a house where I have an under 4% rate to go then trade up to a higher interest rate payment? And so you've got existing home sales that are cratering because people don't want to move. And then you have new home sales that are also stagnating, even though builders are offering these sweeteners and these incentives. So it's fair to say that the housing market is stuck. Now, beyond the headlines, what does this mean? What are the implications of this? Well, if you're an investor and you're looking at housing stocks, um, this is concerning. This would be concerning to me. I don't own any home building stocks. I'm not going to mention any builders or stocks by name, but I'll just say this: aggregate demand is down, but margins are shrinking too. Because what home builders are doing through their lending arms is they're directly taking a bite out of profits by offering these mortgage rate buy downs to new home buyers. And so what they're trying to do is they're trying to spur purchase activity. They're hurting their margins to do it. And what you're seeing is less incremental profit on each sale that they're making, and you're seeing less sales overall. So that's bad news on both sides of the equation. Not great news for the big builders. And bigger picture, longer term, I think that this data really flies in the face of a lot of the conventional wisdom that I'm seeing and hearing just out there in the economy. The conventional wisdom is this, that if interest rates come down, the housing market will unlock. And in a segment of the housing market, we're actually seeing interest rates come down. You go to a home builder, they have their own lending arm, they want to sell you a new house. You are seeing in that environment, interest rates are 5%, they're not 7%. And yet it's not spurring purchase activity. And so when you hear people say, look, when interest rates come down, activity in the housing market's going to pick back up, maybe that's true, but from what I'm seeing in the market right now, that's not a done deal. It's not something I would necessarily go to the bank on. And so what we actually need to rescue the housing market, if you will, is we need more supply to actually bring prices down. This isn't just an interest rate conversation, it's a price conversation. And so in the US, we have a chronic undershortage of homes. I believe it's around 4 million homes that we're short of here in the US. And until, you know, we start to see kind of evenly distributed building across the country, until we start to see supply begin to catch up with the demand that's locked out there, we're not going to see prices come down. And even in an environment where interest rates come down, if prices don't come down, I think you still might see a lot of buyers on the sidelines. The dilemma for home builders is in an environment like this, they don't want to increase supply. When demand is already low, when activity is already slowing, this isn't the right time from a business perspective and from their perspective to continue to invest in new stock and new supply. So this isn't just a business conversation. It's not just a business problem to solve. It's a policy problem to solve as well. And this is something that I'll be paying attention to as we move forward here over the next few months and honestly even over the next few years is can local and state governments incentivize growth in housing supply? And do the economics of that still make sense for some of these home builders? So that's Market Outsiders for today. Hopefully, that gives you a little bit more insight into what's happening in the US housing market and why it matters for you. You might own a home, you might be looking to buy a home. So you might be interested from a personal perspective. You might be an investor looking at some of these home building stocks. You might be interested from that perspective. And all of us have a stake in what's happening in the US economy. And when any one sector of the economy makes up 16% of GDP, it's worth paying attention to. So let me know in the comments below what you think. Do you think that demand will increase when interest rates go down, or do you think that this is a poor sign for what's to come in the housing market? We may not have all the answers, but what we're trying to get to on Market Outsiders is asking the right questions. I hope you have a great weekend. We'll see you on Monday morning.